What if I told you that 2025 just became the absolute best year in over a decade to write off 100% of your business vehicle? I'm talking about massive tax savings that could put thousands of dollars back in your pocket. With the new One Big Beautiful Bill Act that just passed, the vehicle tax deduction has completely transformed, and most business owners have no idea about these game-changing opportunities because this is the most significant tax overhaul I've seen since 2017. The new tax laws are packed with provisions that directly impact how you can deduct vehicles. And what makes this particularly exciting is that many of these changes took effect immediately. We're not waiting until 2026. These benefits are available right now for your 2025 tax planning, which is why today I'll break down the two fundamental methods for writing off your vehicle, how the new laws affect the limits, and real-world examples with actual dollar amounts. So by the end of this video, you'll know exactly how to leverage these new 2025 tax changes to maximize your vehicle deductions, whether you're driving a compact car or a heavy-duty truck. But really quick, if we haven't met yet, I'm Sean's clone, a licensed tax professional who personally researches and writes every script you see from me. And while Sean is helping people save on taxes, I'm here to share his knowledge with you. But if you have any questions, the real Sean reads every single comment and tries to respond to most. Also, if you need help with tax planning, click the link below to get a free consultation to start saving more money before the tax year ends. Now, let's get started with Chapter 1, the two methods for writing off your vehicle, updated for 2025. Let me start with the fundamentals, because even if you're familiar with vehicle deductions, the 2025 changes have modified how these methods work and when you should use each one. Let's begin with the first method, which is often the simplest choice for many business owners. Method 1, the standard mileage method. The standard mileage method remains the simpler of the two approaches, and it's gotten even better for 2025. Here's how it works. You track every business mile you drive, and the IRS allows you to deduct a specific rate per mile. For 2025, the IRS has set the standard mileage rate at 70 cents per mile, according to IRS Notice 2025-5. This represents a significant increase from previous years and reflects the true cost of operating a vehicle in today's economic environment. This rate is now indexed for inflation under the new law, which means it will automatically adjust each year to maintain its purchasing power. This is huge because in previous years, the mileage rate often lagged behind actual vehicle costs, especially during periods of high inflation. Let me show you the math on why this matters. If you drive 30,000 business miles in 2025, your deduction would be $21,000. Compare that to 2020 when the rate was 57.5 cents per mile. The same 30,000 miles would have only given you a $17,250 deduction. That's a $3,750 difference just from the rate increase. But here's where the new law gets interesting. The One Big Beautiful Bill Act includes provisions that make it easier to substantiate your mileage deductions. The new law recognizes electronic tracking methods and JITS-based mileage logs as acceptable documentation, which means apps like QuickBooks Online Mobile, MileIQ, or even your smartphone's built-in tracking can provide audit-proof records. The standard mileage method works for any vehicle you use for business, regardless of weight or cost. You can use it on a Honda Civic or a Ford F350. The method is the same. However, there are some important limitations to keep in mind. You cannot use the standard mileage method if you previously claimed depreciation on the vehicle using the actual expense method, and you cannot use it if you operate 5 or more vehicles simultaneously. Now, let's move on to the second method, which offers significant advantages, especially with the 2025 tax changes. Method 2, the actual expense method. The actual expense method is where the 2025 tax changes really shine. This method allows you to deduct the actual cost of operating your vehicle for business purposes, and the new law has significantly expanded what qualifies and how much you can deduct. Under the actual expense method, you can deduct gas and oil repairs and maintenance insurance premiums, registration and licensing fees, tires and other parts, lease payments if leasing, and depreciation if you own the vehicle. Now, here's something important to clarify about the new car loan interest deduction. The One Big Beautiful Bill Act includes a provision that allows you to deduct up to $10,000 in car loan interest as an above-the-line deduction for tax years 2025 through 2028. But this applies specifically to personal non-business vehicles and only for loans originated after December 31st, 2024. This is separate from your business vehicle deduction and represents a completely new tax benefit for qualifying taxpayers. The deduction phases out for single taxpayers with modified AGI above $100,000 and married filing jointly taxpayers above $200,000. But for eligible taxpayers, this can provide significant additional tax savings on top of your business vehicle deductions. Here's how the actual expense method works. You calculate the total cost of operating your vehicle, then multiply by the percentage used for business. So if your total vehicle expenses were $15,000 and you used the vehicle 80% for business, your deduction would be $12,000. The key advantage of the actual expense method in 2025 is the enhanced depreciation depreciation benefits, which we'll dive into next. But first, let's discuss how to choose between these two methods, as it's a critical decision for maximizing your deductions. The decision between standard mileage and actual expense method has become more nuanced with the 2025 changes. Here's my framework for making this decision. Use standard mileage. When you drive high mileage over 25,000 business miles annually, or your vehicle is relatively inexpensive, under $30,000, or you want simplicity and minimal record keeping, or your vehicle is used less than 50% for business. On the other hand, use actual expense. When you have an expensive vehicle over $40,000, or your vehicle qualifies for enhanced depreciation benefits, or you drive relatively low business mileage, or you want to maximize first-year deductions, or you're purchasing a heavy vehicle or over 6,000 pounds. The new law has made the actual expense method more attractive for many business owners because of the enhanced depreciation benefits. Which brings me to Chapter 2, Revolutionary Depreciation Changes. For vehicles under 6,000 pounds placed in service during 2025, the depreciation limits have been updated to: Year 1, $20,200, including $8,000 bonus depreciation. Year 2, $19,600. Year 3, $11,800. Years 4 through 6, $7,060 each year. These limits apply to the business use percentage of the vehicle. So if you use your vehicle 100% for business, you get the full limits. If you use it 75% for business, you get 75% of these limits. Here's where it gets interesting. While the new law includes provisions for enhanced depreciation on certain manufacturing property, this typically doesn't extend to vehicles themselves. The manufacturing property provision is primarily designed for manufacturing equipment and processing facilities, not business vehicles. Now let's talk about heavy vehicles, where the tax benefits get even more substantial. For vehicles over 6,000 pounds, the advantages are even more significant. The new law increases the Section 179 deduction limit to $2,500,000, up from $1,160,000, with the phase-out threshold increased to $4 million. This means that for heavy vehicles, trucks, large SUVs, vans, and other commercial vehicles over 6,000 pounds, you can potentially write off the entire purchase price in the first year using Section 179 up to $2,500,000. Let me break down the weight categories with the updated 2025 limits, 6,000 to 14,000 pounds. You can use Section 179 to deduct up to $31,300 in the first year, increased from the previous $25,000 limit, plus any remaining amount can be subject to bonus depreciation. Over 14,000 pounds, you can use Section 179 to deduct the entire purchase price in the first year, up to the $2,500,000 limit. Here's a powerful strategy. Combine Section 179 with bonus depreciation. For a vehicle that costs more than the Section 179 limits, you can use Section 179 for the maximum amount, then apply 100% bonus depreciation to the remainder. Let me walk you through a real scenario that shows the power of these new rules. Say you're a contractor and you need to purchase a $75,000 heavy-duty pickup truck that weighs 8,500 pounds for your business. Under the old rules with declining bonus depreciation, Section 179 deduction, $25,000. Remaining amount, $50,000. 40% bonus depreciation on remainder, $20,000. Total first year deduction, $45,000. Amount carried forward, $30,000. Under the new 2025 rules, Section 179 deduction, $31,300. Remaining amount, $43,700. 100% bonus depreciation on remainder, $43,700. Total first year deduction, $75,000, the entire truck. If you're in the 24% tax bracket, this represents a tax savings of $18,000. If you're in the 37% bracket, you're saving $27,750. Essentially, you're getting that truck at a massive discount courtesy of the tax code. With the depreciation rules covered, let's move to Chapter 3, Strategic Vehicle Planning. Now that you understand the mechanics, let's talk strategy. The 2025 tax changes create specific planning opportunities that smart business owners should consider. Let's start by discussing the timing of your vehicle purchase, as it can significantly impact your tax benefits. The new law creates some interesting timing considerations. Since 100% bonus depreciation is now permanent, you don't have the same urgency to purchase before year end that existed under the declining bonus depreciation rules. However, there are still strategic reasons to consider timing. First, the enhanced Section 179 limits are effective immediately, so you can take advantage of the increased
$2,500,000 limit and the higher $31,300 SUV limit for 2025 purchases.
Second, If you're planning multiple vehicle purchases, spreading them across tax years might help you manage your overall tax liability more effectively. Here's a strategy I recommend to clients. If you need multiple vehicles, consider purchasing your heaviest, most expensive vehicle first to maximize the Section 179 and bonus depreciation benefits. Then, for lighter vehicles, evaluate whether the standard mileage method might actually provide better long-term benefits. But it's critical to understand how to calculate your business use percentage, as it's a key factor in maximizing deductions. One of the most important aspects of vehicle deductions is the business use percentage. The new law doesn't change the fundamental requirement that vehicles must be used more than 50% for business to qualify for accelerated depreciation, but it does provide some clarity on documentation requirements. Here's what qualifies as business use: driving to meet clients or customers, traveling between business locations, making deliveries or service calls, attending business-related meetings or conferences, any driving that is ordinary and necessary for your business. What doesn't qualify: commuting from home to your regular workplace, personal errands or family activities, vacation travel, unless combined with business. The key is documentation. The new law recognizes electronic tracking methods, so using a smartphone app or GPS-based system to track your business miles is now explicitly acceptable for audit purposes. Now, let's explore whether leasing or buying is the better option under the new tax rules. The enhanced depreciation benefits have shifted the lease versus buy analysis significantly in favor of purchasing. Here's why. When you lease a vehicle, you can deduct the lease payments, business percentage, but you cannot claim depreciation. With the new 100% bonus depreciation rules, purchasing often provides much larger first-year deductions. Let me show you an example. If you were leasing a $50,000 SUV, monthly lease payment would be $600, annual lease cost would be $7,200, business use percentage would be 80%, annual deduction would be $5,760. If you were purchasing the same $50,000 SUV, assuming it qualifies for bonus depreciation, first year depreciation deduction would be $40,000, 80% business use. Estimated tax savings in the 24% bracket would be $9,600. Effective first year cost would be $10,400. The purchase option provides significantly more tax benefits, especially in the first year. However, leasing might still make sense if you prefer lower upfront costs, want to drive newer vehicles more frequently, or if the vehicle doesn't qualify for enhanced depreciation benefits. Now that we've covered the basics of planning, let's dive into Chapter 4, Advanced Strategies and Considerations. One of the most overlooked provisions in the new tax law is the car loans interest deduction. This allows up to $10,000 as an above-the-line deduction for interest paid in tax years 2025 through 2028 on loans originated after December 31st, 2024. This deduction is specifically for personal non-business vehicles and is separate from your business vehicle deduction. It's subject to income limitations. The deduction phases out for single taxpayers starting at $100,000 of modified adjusted gross income, and for married filing jointly, it phases out starting at $200,000. Here's how this works in practice. If you finance a $40,000 personal vehicle at 6% interest, your first year interest payments would be approximately $2,400. If you qualify for the deduction, this $2,400 reduces your taxable income dollar for dollar, potentially saving you $576 to $888 in taxes depending on your bracket. For business owners, this creates an interesting strategy. You might finance personal vehicles even if you could pay cash, because the interest deduction provides additional tax benefits. This is especially powerful when combined with the business vehicle deductions we've discussed. Another important consideration is planning for depreciation recapture, which can impact your taxes when you sell or trade in a vehicle. One critical aspect that many business owners overlook is depreciation recapture. When you sell or trade in a vehicle that you've depreciated, you'll have to recapture some of that depreciation as ordinary income if you sell for more than the depreciated value. Here's how it works. If you fully depreciate a $50,000 truck and later sell it for $20,000, you'll have to recognize $20,000 as ordinary income taxed at your regular tax rates, not capital gains rates. It's important to note that vehicle trade-ins no longer qualify for like-kind exchange treatment under Section 1031. This changed in 2018. Whether you sell or trade in your vehicle, you'll trigger depreciation recapture if the sale price exceeds the depreciated basis. The new law doesn't change depreciation recapture rules, but with the enhanced depreciation benefits, it becomes more important to plan for this. Here are some strategies. Time things perfectly. Plan the sale or trade-in for a year when your income is lower, reducing the tax impact of recapture. Replacement when necessary. If you must sell, consider purchasing a replacement vehicle in the same tax year to offset the recapture income with new depreciation deductions. Hold on longer. consider keeping vehicles longer to minimize the recapture impact, especially if the vehicle still serves your business needs effectively. To ensure you can claim these deductions without issues, let's move to Chapter 5, Record Keeping and Compliance. The new law provides some clarity on acceptable documentation methods, but the fundamental requirements remain the same. For vehicle deductions, you need to maintain records of business purpose. Why was the trip necessary for business? Business relationship. Who did you meet or what business was conducted? Date and time. When did the business use occur? Destination. Where did you drive for business? Mileage. How many miles were driven? The good news is that electronic records are now explicitly acceptable. Smartphone apps, GPS tracking, and digital logs can provide audit-proof documentation. To help you avoid pitfalls, let's jump to Chapter 7. Common mistakes to avoid. Based on my experience, here are the mistakes I see often and ones I am expecting over this next year. Let's start with the most common error I see among business owners. Mistake number 1. Mixing personal and business use without proper documentation. Many business owners use their vehicles for both personal and business purposes, but fail to properly document the split. This can result in lost deductions or problems during an audit. The solution here is simple. Maintain detailed records and be conservative in your business use percentage calculations. Another critical mistake to avoid is overlooking the tax implications of selling a depreciated vehicle. Mistake number 2. Forgetting about depreciation. Recapture. Taking large depreciation deductions feels great until you sell the vehicle and face depreciation recapture taxes. Remember, both sales and trade-ins trigger recapture. There's no like-kind exchange protection for vehicles. The solution to this is to plan for eventual sale or trade-in and consider the long-term tax implications of your depreciation strategy. It's also easy to mix up the new car loan interest deduction with business vehicle financing. So let's clarify this next. Mistake number 3. Confusing personal and business car loan interest. The new car loan interest deduction applies only to personal vehicles and loans originated after December 31st, 2024. Don't confuse this with business vehicle financing, which follows different rules. My solution would be to keep personal and business vehicle financing separate and understand which deductions apply to each. Finally, don't overlook how state tax rules might affect your deductions. Mistake number 4, not considering state tax implications. While we focused on federal tax benefits, don't forget that state tax laws may differ. Some states don't conform to federal bonus depreciation rules. Now, these are 4 mistakes that any taxpayer could make, but of course, there could be others. If you are planning to purchase a vehicle and worried about making a mistake, then seek professional advice. Click the link in the description below to get a tax plan customized for you. Looking ahead, let's discuss Chapter 8. Planning for 2026 and beyond. Some provisions in the new law are temporary, so let's explore how to plan for their expiration. While many of the 2025 tax changes are permanent, some provisions have expiration dates. The car loan interest deduction, for example, only applies through 2028. Plan accordingly for when these temporary benefits expire. It's also worth noting that while the Section 199A qualified business income deduction remains at 20% for 2025, this enhanced deduction rate could make business vehicle ownership even more attractive in future years. To wrap things up, let's summarize the key takeaways. The combination of permanent 100% bonus depreciation, expanded Section 179 limits with the new $31,300 SUV cap, increased 70-cent standard mileage rates, and new personal car loan interest deductions creates a perfect storm of tax benefits for vehicle owners. Whether you're driving 5,000 miles per year or 50,000 miles per year, whether you need a compact car or a heavy-duty truck, there's a strategy in the new tax law that can save you significant money. Don't let these opportunities pass you by. If you need help planning for your own vehicle purchase, click the first link down in the description below. Or if you want to learn more tax strategies that may help you keep more of your hard-earned income, consider watching this video next. As always, thanks for watching, and I'll see you in my next video.